Singapore Airlines called its own balance sheet sound in the same release that reported a net loss. The market barely blinked, and the stock actually rose. Let us go through what actually holds up. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. I have been watching the fuel cost line for 2 quarters now, and this is the quarter it finally broke through to the net result. This is not a demand problem. Revenue hit a record 5,714 million Singapore dollars, up 19.3% year-on-year, and yields actually strengthened. The group carried 10.9 million passengers, and the passenger load factor only dipped half a point to 87.1%. The $76 million net loss is a real swing from the $186 million profit last year, but it is not from a demand collapse. What actually erased the quarter was fuel. Net fuel cost jumped 78.5% to 2,253 million Singapore dollars, and fuel before hedging more than doubled. The $376 million hedging gain was a genuine cushion, but it was not enough to save the operating line, which fell 73.8% to $106 million. Add a widening $42 million share of losses from Air India, and you get the net loss. This distinction matters. The core commercial engine of revenue and yield actually strengthened this quarter. The loss came from one external cost shock and an investment drag, not from deteriorating operations. A company absorbing a one-quarter fuel shock looks very different from one under real structural pressure when you check their solvency numbers instead of trusting the press release. Here is the sentence from their own release. A robust balance sheet anchored by cash reserves of $10.48 billion supports operational agility to seize opportunities and sustain long-term investments. That is a confident, specific-sounding claim. Let us run it through the 4 forensic gates to see where they actually land. Starting with gearing, this genuinely clears the bar. Using the reported total debt of $10,743.9 million against total assets, gearing comes to 24.9%. That is well inside the 35% ceiling, and it is directly computable from primary filing data with no estimation required. The other 2 solvency gates are where that claim stops being checkable. The first quarter announcement does not break out a finance or interest expense line, and there is no standalone net debt figure published. A prior reconciliation attempt produced a cash figure that did not match their own reported position. So both of these gates stay open in my tracking until they can be built from a genuinely reconciled source. That specific word is doing a lot of work it cannot back up. A press release can call a balance sheet strong without ever showing you the interest expense line that would let you check the claim. The point is not that they are hiding something. It is that half a checklist passing and half a checklist being unconfirmable are 2 very different things, and only one of them earns that kind of confident description. What is genuinely verifiable and genuinely strong is liquidity. Cash and bank balances rose to $9.1 billion, driven by strong operating cash flow. Add in fixed deposits and undrawn credit lines, and they sit on roughly $13.7 billion in total liquidity against $10.7 billion in total debt. That is a genuinely comfortable cushion, and the part of the claim that actually stands up. The direction of leverage is worth watching. Total debt rose modestly from a new offshore 5-year bond, while shareholders' equity fell. That pushed the debt-to-equity ratio from 0.62 times to 0.65 times. That is a move in the wrong direction during a quarter when the operating result was already under pressure. 1 quarter is not yet a pattern, but 2 in a row would be. They hold a 25.1% strategic stake in Air India, framed as a key pillar of the multi-hub strategy. But the share of Air India's losses widened by $42 million this quarter, making this the 2nd consecutive period weighing on the net result. The transformation is multi-year, so 1 quarter is noise, but 2 in a row on a strategic stake this size starts to look like a trend worth naming. Turning to the yield hurdle. At a market price of $7.77, the ordinary dividend per share of 27 cents produces an ordinary yield of 3.48%. That fails the 4.7% minimum hurdle by 122 basis points, and it sits below the 4.0% CPF special account benchmark. They also run a guided time-bound special distribution package of 10 cents per share. Including those specials would produce a yield of 4.76%, technically clearing the hurdle, but I exclude special dividends from the governing yield figure. A guided capital return program funded outside recurring operating cash flow is a different animal from a durable, organically funded distribution. Income investors should use the 3.48% figure. There is one live caveat before this figure gets treated as settled. The 54th Annual General Meeting was held on the 24th of July, but formal shareholder approval of the final dividend has not yet been published through investor relations channels. I am treating the ordinary dividend as directionally reliable, but this figure will be updated on confirmation. This places the stock in Zone 4-. Caution. The verdict reflects a strong liquidity position, but a compound profile of a yield miss plus an elevated soft flag count are the constraints. This is a compound call. The ordinary yield fails the hurdle by a wide margin. Weighted soft flags sit at 2.0, driven by dependency on the guided special distribution program, and a net profit compression pattern extending into an outright quarterly net loss. Either factor alone qualifies for the minus suffix, but together they reinforce the call. The 4.7% yield hurdle is benchmarked against the CPF special account rate to demand fair risk compensation for holding equity in a cyclical, fuel-exposed business. The underlying commercial performance remains genuinely strong. Zone 4- means the current income return does not adequately compensate for the volatility this framework is built to flag, not that the business itself is broken. This framework is calibrated for retirement drawdown. An investor with a genuinely longer runway may reasonably tolerate the volatility this framework flags, and capital allocated beyond retirement drawdown needs may be held to a different standard. This simply describes how the hurdle is calibrated in the first place. In this market, the difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. The red flags are always there. The question is whether you had the forensic framework to read them in time. Iggy's elite investors do not chase the headline yield. They get the full forensic breakdown, the gearing ratios, the occupancy gaps, and the debt overhang verified before the market opens for $12 a month, less than 2 kopi and kaya toast sets at Raffles Place. Stop being the exit liquidity and start being the analyst. Looking at fair value, an indicative pull produced $8.33, implying roughly 7% upside. But because that same data session produced a materially wrong debt figure, this is indicative only. If it holds up, it may trade modestly below fair value while still failing the yield hurdle. That means the case for it rests on capital appreciation potential, not income. A full peer comparison against other full-service regional carriers is not included here because verified forensic-grade data for direct peers was not available within this session sourcing. A future piece revisiting this alongside a peer set is a natural follow-up once that data is properly verified rather than assembled from mismatched sources. The stock rose the same week they reported a net loss. That is not the market being irrational. It is reading the loss as a fuel cost shock on top of a genuinely stronger commercial quarter. But telling yourself the market is not worried quietly replaces the homework of checking yield against your own threshold. Those are two separate questions. Separate the operating story from the balance sheet claim. The revenue and yield performance was genuinely strong, and the loss is traceable to one external cost line. Do not let a net loss headline obscure that, but do not let strong revenue wave through an unverified solvency claim either. Treat open as an honest answer. When a company's disclosure does not give you enough to calculate the interest coverage ratio or net debt to EBITDA, say so. A checklist with 2 open items is far more trustworthy than one with 2 guessed numbers. Watch the Air India drag and the debt to equity direction as a pair. Neither is disqualifying on its own this quarter, but 2 consecutive quarters of Air India losses combined with a second consecutive rise in leverage would be a meaningfully different picture. And that is the specific combination to check next result. When you next read a company's own description of its balance sheet, ask yourself this question. How many of the words in that confident sentence would actually survive being run through a forensic checklist instead of just being taken as read by the market? That is the difference between reading the news and doing the homework. The commercial engine remains intact, but the verified income simply does not clear the hurdle for a retirement portfolio. Unverified solvency claims require patience, not blind trust. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Get everything 0-day access on both platforms, the full Red Zone watchlist, and institutional grade cheat sheets with Iggy's elite investors, $12 a month. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.